In the past few months, there's been a lot of noise around the market. Prices going up and coming down, gold and silver falling and then rebounding, crypto witnessing massive decline and stocks testing people's patience. In these moments, a lot of people's mindsets have been programmed to think that they are losing money because they aren't smart enough or because they didn't invest at the perfect time. But here's the truth no one tells you. Wealth isn't built on intelligence, it's built on habits. And in today's video, we are going to look into the 7 habits that smart investors use to build wealth and retire early. The number 1 habit is consistency. Smart investors don't wait for the perfect time to invest. Rather, they invest at all times, whether the market is up or down, because they understand one thing. Wealth isn't built by one perfect move, but by showing up consistently over time. Think about this. When the market is booming, a lot of people rush to catch the next big move. And they end up getting caught in classic and well-planned pump-and-dump schemes, likely in speculative assets like crypto, which are highly volatile and can pump and dump within minutes. So, instead of chasing the hype, smart investors focus on steady, repeatable actions that compound over time. And those small actions are what eventually help them to build 7-figure portfolios without having to worry about the market behavior. Remember this, consistency isn't about how much you invest, it's about how unshakable you are. A smart investor buying a boring index fund every single month, regardless of whether gold is up or crypto is crashing, will almost always outperform the genius who waits for the perfect moment. The number 2 habit smart investors use to build wealth is risk management. Let me tell you this, smart investors don't focus only on how much they can make. They focus first on how much they can lose. That is why before they enter into any investment, they ask themselves one question. What happens if this goes wrong? And this is the question most people skip before investing in highly risky speculative assets like crypto. People lose money not because the market is bad, but because they risk too much on one idea. They go all in with their entire capital. Some even go as high as investing their emergency fund in rent money, betting everything on a single asset while hoping to double their capital within a short time. And when the market turns, it doesn't just hurt, it wipes them out, erasing savings that took years to build. Here's the truth you need to know. You don't build wealth by hitting home runs. You build it by staying in the game long enough for compounding to work. That's why the ultimate goal of a smart investor is to protect their capital. Because without capital, there is no recovery, no compounding, and no second chance. Remember this, risk management isn't about fear. It's about survival. And in investing, the ones who survive the longest are the ones who end up winning. The number 3 habit smart investors use to build wealth is patience. On January 30th, precious metal assets like gold and silver plummeted sharply, triggering a wave of panic selling. Many people immediately assumed it was the beginning of a deeper crash and rushed to offload their holdings. It is moments like that which reveal the difference between speculators and investors. Smart investors understand that real wealth doesn't happen quickly, it happens quietly. That's why they don't expect instant results, and they don't panic when the market witnesses a downturn. Instead, they keep investing, lowering their average buying price using the power of dollar cost averaging, DCA. And that's where most people make mistakes. They invest today and expect returns tomorrow. When nothing happens, they lose confidence, sell too soon, and move on to the next shiny opportunity. This is especially common in fast-moving markets where social media makes it look like everyone else is getting rich overnight. While in reality, those gains are rare, temporary, or exaggerated. Instead of rushing the process, smart investors give their investments time to work because they understand that investing is a long-term game that rewards patience, not impatience. They let compounding do what it does best, and most importantly, they don't invest what they cannot afford to lose. The 4th habit smart investors use to build wealth is sticking to a clear strategy. Smart investors don't invest randomly in any asset they see. They don't jump from one idea to another, and they don't change plans every time the market moves. Instead, they take their time, do the research, understand the asset, and invest with a clear long-term plan. That's one of the major differences between speculators and investors. A lot of people invest without purpose or a clear strategy. I have a friend who does that. He throws money into any asset that is making waves across the market. His reason is that before the market witnesses a pullback, he is already out. But guess what? He has lost more than he has gained over the past year. That's because the market is unpredictable. Anything can happen at any moment. From tariff news to global geopolitical news, any major event can trigger a massive sell-off. Smart investors don't react to headlines. Instead, they follow a strategy they understand and can stick to. They know what they're investing in, and they know how long they plan to stay invested. Because here's the truth. A bad strategy followed consistently will often outperform a good strategy followed inconsistently. The beauty of having a clear strategy is that it removes emotion, reduces mistakes, and keeps you focused when the market gets noisy, and that focus is what turns effort into results. The fifth habit is that smart investors control their emotions. This is one of the most common habits that wipe out people's portfolio. I was once in this trap, buying out of excitement and selling out of fear, only to watch the market do the opposite. You begin to think that you don't know what you are doing, blame upon blame, sleepless nights and overthinking. But here is the thing. Smart investors don't let emotions make decisions for them. They don't buy because of excitement. They don't sell because of fear. They don't allow fear and greed to push them into panic decisions they didn't plan for. Instead of reacting emotionally, smart investors pause and stick to logic. They follow their strategy, they trust their process, and they make decisions based on rules, not feelings. Because here's the truth. The market doesn't reward emotion, and it rewards discipline. And when you understand that, you begin to respect your plan and stop reacting to noise. And once you control your emotions, you begin to see positive results. The sixth habit smart investors use to build wealth is choosing quality assets. I know a lot of people might not see it as a habit, but smart investors always go for quality rather than chasing hype or running after get-rich-quick schemes. In essence, they don't just ask, how fast can this stock grow? Rather, they ask, will this still hold value in the future? The answer helps them in making better and smarter investment decisions. That's what is lacking in many people. You see most people chasing trends on social media, buying whatever they see simply because it is trending. They invest in assets they don't fully understand simply because they see the price moving. At the end, their portfolio is full of assets with no real value, no strong foundation, and no long-term relevance. And they end up stuck at one point. Smart investors focus on assets with real substance, businesses that generate cash flow. Instead of chasing hype and risky assets like crypto, they invest in an index fund that tracks the broader market. They invest in ETFs that give them broad exposure to the stock market while limiting their risk. And they use real estate to protect their wealth because it offers steady cash flow from rent, long-term property appreciation, and higher resale value over time. If you are new to investing, always remember this. Not everything that goes up is valuable, and not everything valuable moves fast. Quality assets don't always look exciting in the short term, but over time they reward patience, discipline, and consistency, and that's how lasting wealth is built. The seventh and final habit that smart investors use to build wealth is diversification with a long-term mindset. In the last point, we talked about smart investors putting their money in proven assets like ETFs and real estate. But smart investors don't stop there. They don't put all their eggs in one basket because they understand that no single asset wins all the time. They know that markets move in cycles and relying on just one asset exposes you to unnecessary risk that can wipe out years of savings in a single downturn. That's why smart investors diversify as a way to protect what they have already built over the years while also staying invested for the long term. Most people think that putting all their money in one asset will guarantee faster and more returns. Although it might work sometimes, but it increases risk. That's because one bad move, like a market crash, can wipe out everything or severely deplete a portfolio. So instead of betting on one outcome, smart investors spread their risk across different assets like stocks, ETFs, real estate, or sometimes even precious metals like gold and commit to the long term? Because here's the truth. Diversification protects you in the short term, and long-term investing rewards you over time. Always remember this. Wealth isn't built by being right once. It's not built by catching the perfect opportunity, timing the exact bottom, or making one lucky decision. Wealth is built by staying invested long enough through ups and downs, uncertainty and noise, and by spreading your investments across different assets so no single mistake can destroy your progress. And when you combine these 7 habits, you stop thinking short-term and start thinking in decades. You stop chasing quick wins and let compounding do the heavy lifting. And over time, compounding quietly turns small, steady decisions into meaningful, life-changing wealth. That's how smart investors win. Not overnight, but for the long run. Remember, this video is not financial advice. It is only for educational purposes. Investing is risky and can wipe out your portfolio if you don't know what you are doing. Always do your own research before investing, and do not invest what you cannot afford to lose. If you found this video helpful, like, share, and subscribe. Thank you.